A comprehensive guide to tips for Fidelity DRIP starts with understanding what DRIP stands for, which is Dividend Reinvestment Plan. This plan allows investors to automatically reinvest dividends from their investments back into the same investment, thereby increasing the number of shares they own over time. The first step is to open a Fidelity account and enroll in the DRIP program. This can be done online or through their customer service. Once enrolled, any dividend-paying stocks in the portfolio will have their dividends reinvested. A key concept to understand is the power of compounding. By reinvesting dividends, the investor is essentially creating a snowball effect where the dividends earned from the new shares will also be reinvested, leading to exponential growth over time. A practical example of this is if an investor owns 100 shares of a stock that pays a 4% dividend and the stock price is $50. The annual dividend would be $200, which would be reinvested to purchase approximately 4 new shares. Best practices for Fidelity DRIP include starting early and being consistent. The earlier the investor starts, the more time the investment has to grow. It is also essential to monitor the portfolio and rebalance it periodically to ensure it remains aligned with the investment goals. Another important concept is dollar cost averaging, which is the practice of investing a fixed amount of money at regular intervals regardless of the stock price. This helps reduce the impact of market volatility and timing risks. In conclusion, Fidelity DRIP is a powerful tool for long-term investors. By understanding the key concepts and following best practices, investors can create a portfolio that generates consistent returns over time. It is essential to be patient and disciplined and to avoid making emotional decisions based on short-term market fluctuations. By following these tips, investors can maximize the benefits of Fidelity DRIP and achieve their investment goals.